Afternoon, everyone. I hope you're all doing well, and thank you all for joining us here today. My name is Jessica DiMatteo, and I'm a financial advisor at DiMatteo Group Financial Services. We manage the HBRA 401k, which you may have heard about because we've done several webinars over the past few years. But today we're going to talk about another very important part of everyone's retirement, which is Social Security. First, I want to thank Ken Fish from Touchstone Investments for setting this up and for being a great partner, as well as Brian Doherty, who's going to run this presentation. Brian is a nationally recognized authority on Social Security claiming strategies and a speaker and media commentator on this topic. He also has been a featured speaker for major and regional banks, broker-dealers, and other financial institutions around the country. Brian has more than 25 years of experience in the financial services industry. His background includes high-level executive management positions at several Fortune 500 financial services companies, including president and CEO of KeyBank's investment subsidiary, Key Investments, and vice president and national sales manager for New York Life's Retirement Income Security Division. Currently, Brian is president of PhilTech, a consulting company specializing in Social Security claiming strategies to optimize Social Security income. Brian graduated from Syracuse University with an MBA in finance and received his BS in accounting from Elmira College. Brian has done this presentation for us at other events in the past, and we think you'll find it informative. If you have any questions, please raise your hand on Zoom, and we'll host a Q&A at the end. Brian, we really appreciate you doing this, and with that, I'm going to kick it over to you.
Thank you, Jessica, and thank you, everybody, for coming today. I'm very confident going to make it worth your while because I'm going to show you some things about Social Security I don't think you've ever seen or heard before, and some of them, one in particular, I think you're going to find to be amazing. But let me quickly tell you how I got here to become a Social Security expert. I've been in the financial services business for over 35 years, but it was only, 15 or 16 years ago when I stumbled on Social Security. And at the time, I actually worked for an insurance company, New York Life, on their investment side, not the life insurance side. And one of the things we did in 2007, 2008, we created this retirement income planning piece of software. It was really cool. People were starting to get into retirement income planning because all the baby boomers were starting to retire. Anyway, I traveled around the country training thousands of financial advisors like Jessica on retirement income planning. And one of the things I quickly realized is that one of the first pieces of information you put in that software program is your Social Security income. Well, a lot of people that were getting a retirement income plan done hadn't really retired yet. They're getting ready, so they hadn't claimed Social Security. And it was then that I realized if you help people make a better Social Security claiming decision, you can make their assets and savings last a lot longer in retirement, which is probably what everybody wants to do. So at the time, I didn't know anything about Social Security. I decided to educate myself. And from the moment I did my own research. I was blown away. I had no idea Social Security worked the way it did, had all these great features to it, allowed people to do all these great things. And I also realized that hardly anybody knew this in 2007, 2008, because I'd go to all these big national conferences and national meetings, and they'd have all these outside speakers in talking about all these different things, but nobody talked about Social Security. So I thought, you know what, I got to educate people. This is really an incredible program. So I decided I was going to write a book. Now, writing a book wasn't on my bucket list of things to do. In fact, I don't want to write another book because I really didn't enjoy writing this book. I wrote this book on Social Security. It's called Getting Paid to Wait. And I thought it would take me 6 months. It took me 5 years. And when I was done, I didn't know if it was any good. I thought it was, but I'm biased because I wrote the book. But I was very pleasantly surprised when my publisher told me that this book won the International Book Award as the best business personal finance book that year. Turned out there were over 1,000 entries from 15 different countries, and this book beat them all, finished #1. Not only that, This book also won the Eric Hoffer Award as one of the best business personal finance books that year. So this is a multiple award-winning book. I am a multiple award-winning author, and I'm not even trying to sell you the book, because if you want a free copy of my multiple award-winning book, just let Jessica know or your financial advisor know. They'll make sure you get a free copy of my multiple award-winning book, and I'll even sign it for you. But I got to caution you, my book on Amazon retails for 20 bucks. But a few months ago, somebody told me that, hey, Brian, signed copies of your book on eBay are going for 49 cents. So, maybe you don't want me to sign the book. Let Jessica, your financial advisor, know that too. So the stuff I'm going to share with you, I think, is the best stuff from my book here. So let's get into this presentation. One of the things I realized when I was doing retirement income planning is that your Social Security claiming decision is going to be one of the most important retirement decisions you make. It really is. So you want to make sure you make the right decision, because basically once you do that, you're going to have to live with it for the rest of your life. So you want to make sure you're aware of all your options to get every dime of benefit that you're entitled to. Now, what I'm going to do is I'm going to share with you a few things I think everybody should know about Social Security before they claim. And I don't care if you're married, divorced, widowed, widower, single, people should know these things. And I've also done over 2,500 meetings, like a Zoom call with financial advisors and their clients. And what I realized is that going into these meetings, a lot of the people I'm going to meet with weren't aware of all their claiming options, and we're probably going to leave money on the table in terms of lost benefits. All right. So we don't want that to happen to you. I'm going to share with you like 4 or 5 things about Social Security everybody should know. When I get done, if you still want to claim at 62 or 63, that's fine, but it won't be an uninformed decision. So let me share with you just a couple of compelling reasons why you might want to think about delaying. I'm not saying you got to delay until age 70, but even delaying a couple of years can dramatically increase the size of the benefit you're going to receive. So you're probably aware that you can claim your benefit as early as age 62, but if you do that, you're going to lock into the smallest monthly benefit every month for the rest of your life. Now, there's some math geniuses out there that crunch the numbers and put out white papers, these research papers about what's the best age to claim. And the majority of those math geniuses will tell you that claiming at 62 may not be the best decision to make. Or you can claim as late as age 70, lock into the biggest monthly benefit every month for the rest of your life. And those same math geniuses, they'll tell you that might be a better decision to make. Or you can claim at any age in between 62 and 70. But here's the bottom line. For every year you delay claiming past age 62, your benefit is guaranteed to increase by 6 to 8% per year up until age 70. Now, I call that a risk-free guaranteed rate of return. In this still low interest rate environment, where are you going to find a risk-free guaranteed rate of return of 6 to 8% per year? Nowhere that I know of. I tell people it's one of the best deals around. It really is. And you know what? It gets even better, because you may be aware, and if you're not aware, you're about to learn about the great inflation hedge that's attached to your Social Security, and that's called COLA, the cost of living adjustment feature. Now, a lot of people think if they don't claim, they're not going to benefit from the COLA increases. That's not true. If you delay claiming past age 62, not only you get the 6 to 8% minimum guaranteed increase, but you also get any COLA increases on top of that. Let me give you a quick example. Let me take you back to December of 2021. Let's say you were 62 years old, but you like your job. You decide to work for one more year from age 62 to age 63, and you're going to delay Social Security for one more year. So just by delaying that 1 year, you got a minimum guaranteed increase of 7.15%. The COLA increase in 2022 was 5.9%. You basically add those two together. That's a little bit over a 13% increase just by delaying 1 year, and you locked into that increased benefit for the rest of your life. So let's say a year goes by, and now it's December of 2022, and you're 63 years old, but you decide for whatever reason, hey, you know what? I like my job. I'm going to work for at least one more year from 63 to age 64, and I'm going to delay Social Security for an additional year. Just by delaying that additional year, you got another minimum guaranteed increase of 6.67%. The COLA increase in 2023 was 8.7%. You add those two together, you increase your benefit by over 15% just by delaying that additional year. So just by delaying 2 years from age 62 to age 64, you increased your benefit by over 30%, and you locked into that increased benefit for the rest of your life. Ladies and gentlemen, that's only delaying 2 years. You can delay for 3, 4, 5 years, all the way up until age 70, 8 years. And your benefit is going to be bigger because of the 6 to 8% minimum guaranteed increase and any COLA increases on top of it. And you know what people tell me, they say, Brian, I can't wait till age 70 to claim my benefits. And I'm like, well, that's all right. You don't have to. But if you can just delay for 2, 3, 4, 5 years, your benefit is going to be so much bigger than you had you claimed at age 62 because of the 6 to 8% minimum guaranteed increase and any COLA increases on top of it. It's a great deal. All right, this is just a bar chart that shows you monthly benefit amounts, and that every month you delay, you can see how the benefit increases. Didn't adjust them for inflation. All right, some other reasons why you might want to consider delaying. One is longevity. I'm just going to spend a minute on life expectancy. I think I'll surprise you with a complete definition of that. How to maximize the dollar benefit of COLA, what I was just talking about, the cost of living adjustment feature, how you can get the biggest pay raise every year for the rest of your life and your Social Security income. How to maximize the survivor benefit, why every married couple and some divorced spouses that are qualified to get a survivor benefit should know how it works, especially if you're a married or divorced woman. And I'll share with you why in a minute. And then if we have some time, I'll take you back to my retirement income planning days and show you how, just by making a better Social Security claiming decision, you can make your assets and savings last a lot longer in retirement, hopefully as long as you live, if not longer, so you can leave some money to your kids, grandkids, or favorite charity. So let's talk about this life expectancy. You know, this is a term we've heard all our lives. We think we know what it means, but I can almost guarantee you don't know the complete definition. If we put men and women together in this country, they have a life expectancy of age 78. And I think because age 78 is life expectancy, that most people think that most people die by age 78. That's not it. Life expectancy is simply a statistical term. And what it means is, yes, 50% of people will die before age 78, but 50% of people are going to live up to and beyond age 78. And I tell financial advisors and their clients all over the country, if you have a 50% probability of living up to and beyond age 78 and you're doing any kind of planning, you should plan on that happening because that's a high probability. But that's only one aspect of life expectancy. There's a second aspect to it that hardly anybody knows, and that's this. The longer you live, the farther out you push your life expectancy. Now, all these charts and graphs that you're about to see, they're all in my multiple award-winning book, right? So don't forget to ask for your free copy. But this is a cool chart. So on the bottom, the horizontal axis, I have ages from age 65 to age 105. On the vertical axis, we have the probability of living to those ages. So if a man lives to age 65, if we go up to the 50% probability, which is the definition of life expectancy, if he lives to age 65, he pushes his life expectancy out to age 84. If a woman lives to age 65, she pushes her life expectancy out to age 86. And there's a 50% probability that at least one of them, either the man or woman, is going to live to be age 90. Now, for all the guys on the call, including myself, I got some really bad news for you. If anybody's going to live to be age 90, it ain't going to be you. It ain't going to be me. It's going to be all the women on the call. Women overwhelmingly outlive men. It isn't even close. If you look at the number of men and women alive at age 85, there are twice as many women alive at age 85 than there are men. There are 3 times as many women alive in their 90s than there are men. And if I take you back to the 2010 census, there were 53,000 people in this country aged 100 or older. 44,000 of them were women. Women live longer than men. Social Security is a bigger issue for them because they collect their benefit payments for a longer period of time than we do because they live longer than us. Now, I'm not trying to convince anybody that, they're going to live to be age like 90, 95, or 100. But what I am trying to do is to have you realize that there's a probability that you're going to live at least into your mid 80s, if not longer than that. Now, most people underestimate their life expectancy by about 5 years. They think they're only going to live to be like age 80. So if I can move that needle into the mid 80s, that you think you have a high probability of living that long, which you do, then I think I put you in a better position to make a better Social Security claiming decision. And maybe you'll delay claiming your benefits for another year or 2 or 3 or 4, because you're probably going to receive that bigger benefit for a longer period of time because you're probably going to live longer than you think. And one other thing, there's all kinds of research backing this up, and that is that people that transition into retirement with accumulated assets and savings like yourselves, those people live longer than anybody else. You, because you have assets and savings, you're probably going to live longer than anybody else, and that's good news. All right, let's look at this cost of living adjustment feature. Look, I tell people this is the best inflation hedge around. And when I found out our government gives it to everybody for free, because it could be really expensive, but our government gives it to everybody for free, I call it one of our government's greatest gifts because it really is. And for most people, it's going to be the only pay raise they get in retirement. If it's the only pay raise they get, if the only pay raise you get, you probably want it to be as big as possible, right? Unfortunately, a lot of people walk into the smallest pay raise. Let me show you how to change that. And to do that, we're just going to look at this chart up here. These are monthly benefit amounts, right? And we're going to contrast if somebody were to claim their benefit at age 62, if they go to their Social Security benefit statement, it says, Social Security says, well, if you claim at age 62, we're going to pay you $1,875 a month. Now, if that same person, instead of claiming at 62, to wait till age 70, they go to the Social Security benefit statement. Social Security says, well, if you wait till age 70, we're going to increase your benefit to $3,300 a month. Now, the difference between these two amounts starts off at $1,425 more a month. They'd make $1,425 more a month if they waited and claimed at age 70, as opposed to claiming at age 62. All right, now, this column, I'm going to take you out 20 years into the future. We assume an annual COLA increase. It goes up 3% every year. Why did I choose an annual COLA increase of 3%? Because that's the 75-year average for inflation. Okay, so this 1875, 20 years later, with an annual COLA increase of 3%, grows to 3386. This 3300 a month, 20 years later, with an annual COLA increase of 3%, grows to 5959. And now the difference between these two amounts has grown to $2,573 a month. Look, everybody gets the same COLA percentage increase. It doesn't matter when you claim your benefits, but if you apply that same COLA percentage to a bigger benefit, it results in bigger dollar increases every year for the rest of your life. So how do you get the biggest pay raise in retirement? Delay claiming your Social Security as long as possible, ideally till age 70, and you'll be applying that annual COLA percentage increase to the biggest benefit possible, and you get the biggest pay raise every year for the rest of your life. How do you get the smallest pay raise? Claim Social Security as early as possible at age 62. Then you'd be applying that COLA percentage to the smallest benefit possible, and you get the smallest pay raises every year for the rest of your life. And once again, if you say, Brian, I can't wait till age 70, that's fine. But even if you delay for 2, 3, 4, 5 years, your benefit is going to be so much bigger than had you claimed at age 62. And if you delay claiming your benefit, you're still going to get bigger pay raises every year for the rest of your life. All right. Now, the next slide I'm going to show you is the one that always blows people away. I've showed it to well over 100,000 people. I, do some big meetings. Sometimes there's 6, 7, 800 people in the audience. I've presented to a lot of financial advisor groups, and some of them in the audience knew a lot about Social Security. Not many, but some of them did. And they always make a point to come up to me afterwards and say, hey, Brian, where'd you get your stuff? Where'd you get this? Because I've done my own research. I've read a lot, been to the Social Security website. I've been to other webinar presentations, seminar presentations by experts, and nobody talks about what you talk about, especially this next slide. And they say, that's really amazing. Why doesn't every Social Security expert talk about it? I said, I don't know. Well, now you know. If you're a financial advisor, go tell all your clients, and if your client, tell everybody you know, because everybody should know this before they claim their benefits. And it's a really good thing. And people will thank you for telling them. So here's what happened. When I was about to have my multiple award-winning book published, I had some really smart math people check, these charts and the math in it, make sure everything was correct. And a couple of them came back and said, hey, Brian, we understand you implying the COLA percentage to a bigger benefit. You get bigger dollar increases every year for the rest of your life, but you have a very major flaw in your analysis. I said, I do. What is it? And they took me back to this chart here, the one we just went over. And they said, well, look, you have this person claim at age 62, and now this column over here, you take them out 20 years into the future. Brian, if you add 20 years to age 62, that brings you to age 82. Now, instead of the person claiming at 62, you have them wait to age 70. You also take them out 20 years into the future. If you add 20 years to age 70, that brings you to age 90. You are not comparing apples to apples. And if you did, you'd have to look at what this amount, $59.59 a month, would be at age 82, not age 90. It's going to be a lot smaller than $59.59. The difference is going to be a lot smaller, and you're actually going to make the case stronger for claiming early. Now, on the face of it, it seems like a really valid point, but it's not a valid point because of the incredible way that Social Security credits COLA if you delay. In fact, when I first read about this on the Social Security website like 15, 17 years ago, I was like, wait a minute, I can't be reading this right. So I reread it 5, 6, 7 times. I eventually realized I am reading it correctly, and I also realized that only the federal government can do what I'm about to show you. And what I'm about to show you came right off of the Social Security website, okay? So here's how it works. Now, over the years, I do a number of short videos, 3 to 5 minutes on different Social Security topics, put them up on YouTube. They get 15,000, 20,000 views, who cares? But I did one 5 or 6 years ago. It's my most popular video by a factor of 25. 25 times more people watch it than any other video I ever did. And the name of the video was, or actually is, it's still up on YouTube, Your Social Security benefit statements are wrong. And they are. They are absolutely wrong. But they're wrong in a good way because your actual benefit amounts are going to be bigger, substantially bigger than the benefit amounts that appear in your statement. All right. So here, I'm going to take you back to the old Social Security benefit statements when they only showed you 3 benefit amounts. It's just easy to illustrate this, easier. So here, let's say this is the old Social Security benefit statement. Everything played off of the full retirement age. We assume this person at full retirement age is 66. They go to their Social Security benefit statement. Social Security says, well, if you wait till age 66, we're going to pay you $2,500 a month. The second benefit it used to show you was if you claimed as early as possible at age 62. They go to their statement. Social Security says, well, if you claim at 62, we're going to decrease your benefit to $1,875 a month. Third benefit amount they'd show you if you claimed it as late as possible, age 70. Social Security says if you do that, we're going to increase your benefit to $3,300 a month. Now we're going to go down to this chart down here. Column A, I got the claiming ages between 62 and 70. Column B, I show you what happens if this person does claim at age 62. They start off at $1,875 a month, and it goes up a little bit every year because of the annual COLA increase. Now, check this out. If this person actually waits to age 66, they're not going to get $2,500 a month. They're going to get $2,813 a month. Why? Because if they wait till age 66, right, Social Security is going to take this $2,500. Now, keep in mind, they're 66 years old, but they're going to go back in time to the year they were age 62. They're going to see what the COLA percentage increase was for that year when they were age 62, and they're going to apply that percentage to their age 66 benefit, the $2,500. That's going to make that benefit bigger. Then they're going to take that new bigger benefit number. They're going to go back in time to when this person was age 63. They're going to see what the COLA percentage increase was for that year when they were 63 years old. They're going to take that percentage, apply that to that new bigger benefit, and that's going to make it even bigger. They're going to do that for 4 years in a row. So if this person claims at age 66, they don't get $2,500 a month. They get $2,813 a month. Why? Because they get 4 years of what I call retroactive COLA credits. Now, the story gets even better. It gets a lot better if they wait till age 70. They're not going to get $3,300 a month. They're going to get $4,180 a month. Why? Because they get 8 years of retroactive COLA credits. Ladies and gentlemen, that's incredible. Hardly anybody knows that this is the way it works. I think the only people that really are aware of it are the 100,000 plus people I've shown it to, and now you're aware of it too. I think everybody should know this, that your actual benefit amounts, if you delay claiming past age 62, are going to be bigger than the benefit amounts that appear on your Social Security benefit statement. So I want to go back real quick. Remember those really smart math people that said it had a major flaw? Here this person claims it's 62, 20 years later, that brings you to age 82. Now, if they wait till 70, 20 years later, that brings you to age 90. No, this isn't the age 90 benefit, 59.59. You know why? Because the age 70 benefit includes 8 years of retroactive COLA credits going all the way back to age 62. So it includes the 8 years of retroactive COLA credits and the 12 years of credits going forward, which brings their benefit up at age 82 to $59.59 a month. This is their age 82 benefit. All right. And one other thing I want to point out here before I go on, because one of the most frequently asked questions I get is like, okay, Brian, yeah, you showed us the benefits of delaying, but like, what's the break-even age? Yeah, I can wait till age 66 here. I get $2,500 a month. It's bigger than $1,875 a month. But I could have claimed 4 years earlier here at age 62 and got 4 years of these benefit payments, 1875 a month, before I even claimed at age 66. The age 66 benefit is bigger, but how long would it take to make up for that 4 years of income I didn't receive because I didn't claim at 62? I waited till age 66. So get this question all the time. And what I've learned over the years, just my anecdotal being out there doing these and fielding questions, is most of the people that ask me this question happen to be guys. I think guys think, they're smart in math, and they probably are. But I also realize that they've already done the calculation. So when they ask me this, I said, well, have you already done the calculation? 95% of them say, yeah. And I said, what did you come up with? And they say, well, it takes 12 years. It's the same for everybody. The break-even age between 62 and 66. So that means they have to live to be age 78. And then after that, they'd be better off by waiting until age 66 as opposed to claiming at age 62, according to their calculation, that break-even age. So then I asked the question, let me ask you, did you use the benefit amounts on your Social Security benefit statement? And they said, well, yeah. I said, well, now you know that those benefit amounts are too low. So as a result of using the benefit amounts on your Social Security claiming benefit statement, you calculated break-even age that's too high. And if you assume any kind of inflation rate, even 1.5 or 2% over that period of time, you're going to bring that break-even age down anywhere from 2 to 4 years. So, even after getting the correct break-even age, you still may decide to claim at age 62. But, if you're going to make a decision based on some metric, you should calculate it correctly. And everybody calculates the break-even age wrong. It's too high. All right. Let me see where we are. All right. We're making good time here. So I'm going to just take a minute. The survivor benefit, I said it's apply to everybody. This will apply to married couples and a lot of divorced spouses. Okay. You should be aware of how the survivor benefit works. And I've done 2,500 meetings. Probably 75% of them are with married couples. And here's what I tell every married couple before, the meeting starts. I say, look, at whoever has the bigger benefit, the wife or the husband, whichever benefit is bigger, that's the more important one of the two. And you want to delay claiming that benefit as long as possible for two reasons. One, you can both enjoy that bigger benefit while you're both alive. And two, that benefit is eventually going to become the survivor benefit, or the only benefit the surviving spouse is going to receive after the first spouse dies. After the first spouse dies, whoever has the smaller benefit, that benefit is going to stop. You're never going to get it again. Going forward, you're only going to get the bigger benefit every month for the rest of your life. So whoever has that bigger benefit, the longer they delay it, the bigger they make the survivor benefit as well. All right. So let's look at this. I'm going to give you a quick example. We have a wife's full retirement age benefit of $1,900 a month. The husband's is $2,500 a month. Now, the only reason I made the husband's benefit bigger is because 75% of the time the husband has the bigger benefit. Statistically, that's just the way it is. But if the wife had the bigger benefit, I'd recommend her delaying it as long as possible. So over here, the far left, we have the husband's claiming age. We're going to look at if he claims at 62, 66, or 70. All right. Now check this out. This will probably surprise you. Here I have the wife's monthly check or Social Security benefit at age 82. You see, it's the same, $25.73 a month, no matter when the husband claimed. Why is that? Well, believe it or not, regardless of when the husband claimed, I had the wife claim her benefit at age 62. So why would I do that? I just gave you all this, these great reasons why people should delay and the benefits of delaying. Well, there's also those smart math people that put out white papers, research papers. A bunch of them did it. They looked at husband and wife, and they recommended that whoever has the smaller benefit should probably claim it early, even as early as 62. And their logic makes sense to me. Why? Because that's the benefit you're going to receive for the shortest period of time. Because once the first spouse dies, that smaller benefit's going to stop. You're never going to get it again. So if you delay it, you're going to shorten the period of time you receive it even more. So claim it early, even as early as age 62. That's what I did. And 20 years later, with a little bit of annual COLA increases, her benefit grew to $25.73 a month. The husband, if he claimed at 62, 20 years later at 82, he's getting $33.86 a month. We combine these two, we add them both together, their combined Social Security monthly income is $5,959 a month. If you were to annualize that, multiply that by 12, that's almost $72,000 a year. Just their Social Security is paying them almost $72,000 a year when both the husband and wife are alive. But here we assume the husband, excuse me, dies at age 82. Now this benefit 2573 a month stops. Now the wife is only getting $3,725 a month in the form of a survivor benefit, and that's going to pay her $44,700 for the year. Remember, when the husband was alive, their combined income total from Social Security was almost $72,000. Here, husband dies. Now the wife's income drops to $44,700. That's a drop of almost $30,000 a year. That's significant. Now, if the husband had waited till age 66 to claim, the one survivor benefit, $4,515, would have paid the surviving spouse, the wife, $54,180. That's better. But best yet, if the husband had waited till age 70, the one survivor benefit, $59.59, would have paid the wife $71,508 for the year. Obviously, it's a lot easier to live on 71.5 than 44.7 or 54,000. Now, I want to show you one more thing, which I think is really cool, and I'm fairly confident you've never seen anywhere else before. I'd stumbled upon this years ago, just crunching some numbers one day. So all I did was I took the same chart from the previous slide, this same chart, but the only thing I did was I eliminated this age 66 line, all right? So all we're going to do is we're going to contrast if both the husband and wife claim at 62 to if only the husband who had the bigger benefit if he waited till age 70. So if the husband claimed at 62, 20 years later with COLA increases, his monthly benefit's $33.86. The wife's monthly benefit at age 82 is $25.73 a month. Their combined total, those two checks combined, is $59.59 a month. But if only the husband had waited till age 70, his benefit of $59.59 a month, his one benefit check, which becomes the survivor benefit check, this one benefit is as big as these two benefits combined had they both claimed at age 62. That's how you leave a survivor benefit that is as big as two checks in one, greatly reducing the probability that the surviving spouse, which is overwhelmingly the wife, is going to struggle financially after the first spouse dies. All right. And again, every married couple should know how the survivor benefit works. And there's a lot of divorced spouses that are qualified to still receive a survivor benefit based on their ex-spouse's benefit amount. They should know how it works too. Now, let me give you an incredible statistic about the survivor benefit that I got from the Social Security website. Now, keep in mind, Social Security sends out 70 million benefit checks every month. And of those 70 million benefit checks, 4 to 5 million of them are survivor benefit checks. Now, they'll tell you on their website that of those 4 to 5 million survivor benefit checks they send out every month, 95% of them are sent to women. 95%. That backs up my claim that women overwhelmingly outlive men, husbands overwhelmingly predecease their wives. And at some point in the life of a married or divorced spouse that's qualified to get a survivor benefit, that survivor benefit is going to play a very important role in her maintaining her quality of life and standard of living after her husband dies, because the probability that he will predecease her is very high. All right. Now, let me quickly take you through this. I think this is important because I think everybody on the call has some accumulated assets and savings. And when you retire, you want them to last at least as long as you live, hopefully longer again, so you can leave money to your kids, grandkids, or favorite charity. So for this example, we're going to contrast if both the husband and wife, here's their benefits, same benefits, $1,900 for the wife, $2,500 for the husband at full retirement age. We're going to compare, contrast if they both claim as early as possible, they both claim at 62, to a strategy I like called claim early, claim late, where whoever has the smaller benefit claims at 62, and whoever has the bigger benefit waits until age 70. All right. So at age 70, they have an annual income need of $100,000 a year. This is to pay all their bills and have some fun. Now, don't get caught up on the $100,000 benefit or income requirement. If you only need 50,000, 60, 70, 80, to pay all your bills and enjoy your retirement, it still works. Or if you need 120 or $150,000, it still works. Okay. So here, if they both claim at 62, then at age 70, Social Security is providing them with $50,160 of income. But over here, because we use a claim early, claim late, we increase their Social Security income to $71,820 a year. So we've increased their Social Security income by almost 50%, which is pretty good. Now, your financial advisors know that one of the biggest challenges in retirement is longevity risk, or the risk of living too long. Now, it's been my experience that a lot of people think the biggest risk is, dying young. Maybe from a health standpoint, that's a big risk, but from a financial standpoint, no, it isn't. In fact, from a financial standpoint, dying young isn't the problem. Dying young solves all the problems, right? Because when you're dead, you stop spending money. But living a long life and maintaining your quality of life and standard of living the longer you live, that's the bigger challenge, because the longer you live, the harder it becomes for a number of different reasons to maintain your quality of life and standard of living. So longevity risk is the biggest risk. Can you get longevity insurance? Yeah, you can. You know what the best kind of longevity insurance is? Guaranteed lifetime income. Yeah, that's exactly what your Social Security income is. I tell people all over the country, look, you can outlive your assets and savings, but you cannot outlive your Social Security income. You're going to get it to the day you die. And a lot of people take comfort in that. So by helping them make a better Social Security claiming decision, we've got them, we increase their Social Security income by almost 50%, got them 50% more longevity insurance, decreasing the biggest risk in retirement, longevity risk. That's a good thing. Another big risk is in retirement is withdrawal rate risk, withdrawing too much money. Look, I've been traveling all over the country for 14 years, working with thousands of financial advisors, just like Jessica. But so many of them come up to me, Brian, I got clients, they retire with like a couple $1 million, $2 million. They think they're millionaires. Well, technically they are millionaires, but they think it's going to last forever. And they go out and they buy these incredible vacation homes in Florida or Arizona or South Carolina. They buy homes for their kids. They take these incredible vacations. They get all these great cars. And before you know it, 6 or 7 years later, they're down to $600,000 or $700,000. And they say to the financial advisor, what did you do to me? And the advisor says, I didn't do anything. The market's been great for the last 10 years. You have just been spending too much money. Withdrawal rate risk is a big risk. So over here, their income need is 100,000. If they both claim it's 62, Social Security can provide $50,160 of income at age 70. That means they have to withdraw $49,840 from their accumulated assets and savings to meet their income need of 100,000. Now over here, because we increased their Social Security income to almost 72,000, now they only have to withdraw $28,000 a year to meet their income need of 100,000. Look, you don't have to be a math major, I'm not, to realize that if you're only withdrawing $28,000 a year as opposed to $50,000 a year, your assets and savings over here are going to last a lot longer. So by helping them make a better Social Security claiming decision, we greatly reduced withdrawal rate risk. Also a very good thing to do. One of the third biggest risks or challenges in retirement is inflation, keeping up with the rising costs for goods and services. Look, I told you, Social Security has the best inflation hedge around. I believe it, the COLA feature, cost of living adjustment feature. So they need 100,000 here. Social Security provides 50 if they both claim it's 62. So that means 50% of their income need is automatically going to adjust to inflation because of the COLA feature with Social Security. But over here, we increase their Social Security income to almost $72,000. Now, 72% of their income need is automatically going to adjust to inflation. So by making a better Social Security claiming decision, we also put them in a better position to keep up with inflation. All right, recap real quick, and then we're going to move on. So, excuse me, just by making a better Social Security claiming decision, disclaim early, claim late, we greatly reduce longevity risk, withdrawal rate risk, and inflation risk. It's all good. And we put this person in a much better position to be more financially comfortable and less stressed out about money in retirement. Who doesn't want that? All right, coming down to the final stretch here, and then we'll open it up for questions. Look at, there's a lot of cool things about Social Security, and I think one of the coolest is this spousal benefit. This really is a cool feature. So one spouse is entitled to 50% of the other spouse's work history benefit at full retirement age. Let me give you a real quick example of how this works. So we got Chris's full retirement age benefit of $2,000 a month, right? Lee's full retirement age benefit is only $500 a month. Let's say they're the same age and they have a full retirement age of 66, and they both decide to work to 66, retire and claim Social Security. So Chris does that. He gets his $2,000. We didn't adjust these for inflation or retroactive COLA credits. So he gets his $2,000. Lee, because Lee's entitled to a spousal benefit, instead of only getting $500 a month, her own benefit, She can claim a spousal benefit, get 50% of Chris's $2,000 or $1,000 a month. Because Lee can claim a spousal benefit, she doubles her Social Security income. Now, check this out. That's cool enough, but here's something that hardly anybody knows. Let's say I talk to Chris and say, hey, man, Chris, why don't you try to delay to your full retirement age of 66? And Chris says, Brian, look, I've worked for 40 years. I paid all my FICA taxes, right? Those Social Security taxes. I paid hundreds of thousands of dollars into the system. I'm not taking a chance of waiting till 66. What if I die at age 64 before I claim and I end up with nothing? Now, I'm claiming as early as possible at age 62. I don't care if they decrease my benefit, which they do. Instead of Chris getting $2,000 a month because he claimed at 62, it's reduced to $1,500 a month. But you know what? Lee says to Chris, hey, Chris, you know what? I like my job. I'm still going to work till age 66, retire, and claim my benefit, Social Security then, which she does. Works to 66, retires, and she claims Social Security, and she still gets $1,000 a month. You would think because Chris claimed his benefit early is reduced to $1,500 a month, 50% of that is only $750 a month, and that would be the size of the spousal benefit that Lee would receive. But no, it doesn't matter that Chris claimed his benefit early. It has no impact on the size of the spousal benefit Lee will receive. As long as Lee waits to her full retirement age, she's still entitled to get 50% of Chris's full retirement age benefit of $2,000 per month or $1,000 a month. And again, she doubles her income. Now, I need to add one more slide. I keep saying that, but I need to do it. So the opposite is also true. Let's say Chris is going to work until age 70. He's going to wait to claim Social Security at age 70. And if he did that, his benefit would be increased to a little over $2,600. And let's say, Chris still claims her benefit. She's 4 years younger or Lee claims her benefit. She's 4 years younger than Chris. She would still only get $1,000 a month. She's not going to get 50% of the 2,600 or 1,300. She still only get 50% of his full retirement age at $2,000 a month, but it's still a really great deal because she still doubles her income. All right. So we can open it up to questions, but before we do, instead of, you guys can get a free copy of my multiple award-winning book. We're going to give you access to something else for free, which I think is even more valuable. I created a Social Security calculator called the Claim with Confidence Social Security Calculator. I've been using this for the last 12 to 14 years in all these meetings. The output from the calculator, which is a nice PDF, which would have up to a maximum of 3 potential claiming strategies for your personal Social Security situation. We sit down, we use that as a centerpiece of all these meetings, and I help the clients of the financial advisors make the best Social Security claiming decision for their personal situation. And I highly recommend that you take advantage of the calculator so you're made aware of all your claiming options and you get every dime of benefit you're entitled to. And this is a cautionary note. The last thing you want to do is think you can just go to Social Security, call them on the 800 number, go to them in person. In person is a little bit better. Those people at the local offices tend to have a little more knowledge, but unfortunately, Social Security customer service employees give out incorrect and wrong information all the time. It is a huge problem. So if you go there, chances are you might not get the information that you're looking for or the complete information you need to make a good Social Security claiming decision. Now, real quick, before I shut up and open it up to questions, let me give you some concrete example of just how big this problem is. Now, the Social Security Administration, about 5 years ago, they published an internal audit they did on their own customer service employees. This is Social Security itself did an internal audit on their own customer service employees. Keep in mind that 70 million people get a benefit check every month. They only looked at 13,000 cases. And what they concluded was in 82% of those 13,000 cases, or over 11,000 people, were shortchanged. Their employees gave out incomplete or wrong information, and it cost these people $142 million in lost benefits. $142 million. Now that's bad enough, but even worse, they reported these results 5 years ago. They haven't done anything, nothing to correct their mistake. They haven't done anything, nothing to make these people whole. And they just kind of have the attitude, well, yeah, our people gave out wrong information. It cost these people $142 million in lost benefits, but they're just going to have to live with it. So that's only sample size of 13,000. What if they did a sample size of 50,000, 100,000? I'm very confident you'd be looking at lost benefits in the billions of dollars. So I highly recommend that you have an analysis done using my Social Security Claim with Confidence calculator. It's a free service, and it's also a free service for me to get on the phone with you and your financial advisor, look at the output from our calculator, and help you pick the best claiming strategy for your personal situation. And I highly recommend that you do that. So with that, Jessica, I don't know if anybody has any questions in the chat thing or.
Yeah, so thank you, Brian. And if anyone has questions, please click on the raise hand button and we'll go ahead and unmute you guys. I don't.
Can I share with them the most frequently asked question I get after doing live presentations? And
Yeah.
this may be a question that, and I'm sure a lot of people on the call will have the same question. The question is, hey, Brian, how much longer do you think Social Security is going to be around? Because isn't it going broke? And a lot of people think it's going broke, so they better claim their benefits early and get as much money out before they stop making benefit payments. And look, Social Security will never go broke. It won't. They're going to be around making benefit payments into the next century. um, and every year Social Security puts out a report, a trustees report, and it'll tell you what'll happen if the politicians don't do anything to address the long-term funding issue, because there is one. There is a long-term funding issue that has to be addressed, but the math isn't that hard to do it. All right. So they need to fix the system. Now, the last time they fixed the system was in 1983. And Alan Greenspan, who eventually went on to become chairman of the Federal Reserve Board, was a chairman of that committee to fix Social Security. And so what they did was, one of the things they did is they increased the FICA taxes. Those are the Social Security taxes that come out of your paycheck every pay period, and they use that revenue from those taxes to make benefit payments. So they increased the FICA tax to 6.2%, and they knew for about 25 or 30 years, every year they would take in more money from those FICA taxes than they have to pay out in benefits. So every year for 25 or 30 years, there was a surplus. They took that surplus money and they put it in a surplus account. And now there's about $2.5 trillion in that surplus account. But they also knew that there would come a time, like 30 years later, where when all the baby boomers started to retire, that they would take in less money from those FICA taxes than they had to pay out in benefit payments. So they'd have to dip into that surplus account, right, to make full benefit payments. And one other thing that really ticks me off, they talk about the government deficit and they talk about Social Security being a contributor to it. No, it isn't. Social Security does not contribute one dime to the government deficit. In fact, it is illegal for Social Security to borrow money to make benefit payments. They can't do it. Now, they could change that law and maybe say they can, but right now, for what, 70, 80 something years, that hasn't been the case. They can't borrow money to make benefit payments. But that 2.5 trillion, they've been dipping into it, right? Because they're taking in less from the FICA taxes than they have to pay out in benefits. And if the politicians don't do anything to address the long-term funding issue, then in the year 2035, all that money, that 2.5 trillion in the surplus account, will be gone. It'll be wiped out. But too many people interpret that to mean that Social Security is out of money. They have no money. That'll never happen. Those FICA taxes that come out of people's paychecks every pay period, every month, they take in about $100 billion from those FICA taxes, or over $1 trillion a year. So they'll never run out of money. But in 2035, they may not have enough money to make full benefit payments. And they say if the politicians don't do anything before 2035, they'd have to reduce everybody's benefits by about 20%. You get 80% of what you thought you're going to get. Now, once they have to do that, once they do that, I don't think they will. They're on sound financial footing and can meet all their benefit obligations through the year 2098. 2098, almost into the next century. That's the worst thing that could happen. That's the worst case scenario, a 20% reduction. But if they do reduce benefits, Jessica, I don't think, like, I'm over the age of 60. You probably have people on the call over the age of 60. We'll probably be grandfathered. That's what they did the last time in 1983. They did institute some benefit cuts, but they grandfathered and they instituted them over 20, 25 years. And they basically grandfathered people over the age of 60. So anybody over the age of 60, I'm fairly confident that's what they're going to do again. Now, Jessica, you're a lot younger than age 60. Your benefits, you might be looking at a little cut in benefits, but not mine. So good news for me, maybe bad news for you. But Social Security is going to be around for a long time. And, keep in mind that 70 million people get a check every month. By 2035, it's probably going to be 80 to 90 million people. And about 15 to 20% of those people, or 15 to 20 million people, that's the only source of income they have. Social Security is it. So if people say they're going to stop making benefit payments, you're talking like overnight 15 to 20 million people not only joining the ranks of poverty, but being homeless and destitute. Look at it's never going to happen. The politicians know this. Unfortunately, too many times they wait to the last minute to do something. I hope they don't do that this time, but when push comes to shove, they'll get around to addressing these issues. And if there are any benefit cuts, I think they'll grandfather people over the age of 55 or 60.
Thanks, Brian.
Real quick, I don't know if you can see Jessica. Can you see the hands or no? Or is it just me?
I see your hand. And I
Okay,
think-
so yeah, Kathy, I'm not sure because I don't know if she still has a let me see.
Why
I
don't you
don't
just read them?
No. She had her hand up, but I'm not sure. And Johnny, you still with us?
I am.
Okay, go ahead.
Thank you, Brian. So I'm one of those that's under 60. And I remember as far as grade school being told that Social Security wouldn't be there. So our mindset for, I'm a late in the Gen X, right? 47 years old. We've been told for a long time. So our mindset is this is going to be bankrupt and we should make other arrangements as we go through life. And that's kind of the way we've been brought up. My question first, thank you for this. This was great. Because even at 47, this is something that's kind of in the back of our mind, but not priority. But at my age, obviously, we have parents and stuff going through this, so it's nice to know some of the in and outs. My question is a little bit off topic from your presentation. A lot of us have pass-through income or S corps or LLCs, and we're getting a paycheck from the business, but we're also doing a lot of pass-through income. And obviously early on, you're not maximizing your benefits because you're just not making that much money. Is there an age that is kind of a drop dead that if you have the ability to max that out, you should be?
Well, if you want your Social Security benefit to be as large as possible, so over the years, there's an earnings max. Like right now, I believe it's around $175,000 and change. And if you have earnings in excess of that amount, they stop taking out the FICA taxes. So there is a maximum benefit. Like for somebody 67, their full retirement age benefit, the max is a little bit over $4,000 a month. That's at age 67. Now, if you wait till 70, it'll be at least 24% bigger than that. But if somebody has that max benefit, that means that their earnings have exceeded that maximum limit for 35 years. Now, 35 years ago, that maximum limit was a lot lower. It's probably like, $55,000. It goes up a little bit every year with the average wage index. So Social Security uses your highest 35 wage earning years to calculate your benefit. So what I would say is that if you've been keeping your earnings low, that has a negative impact on your Social Security benefit. And if you want your benefit to be higher, I would, start earning more money. You might have to, pay more taxes on it, but that will have an impact on your Social Security benefit. I don't know if you want to get up to $175,000, but that's the max. And that would have a very positive impact on your Social Security benefit, maybe not the amount of taxes you pay while you're doing it. But yeah, so it's 35 years and you being 47, if you have been keeping your income fairly low, you have some time to change that if you want to.
Okay, perfect. Thank you. That answers my question.
We actually had an email from Mark. Mark's still with us?
You might as well just read it if
Okay, so on the last slide with Chris and Lee's spousal benefit, what does it look like if Lee wanted to take benefits at 62 and Chris took at 66?
Okay, so so here's the deal. It's a little more complicated than that, but basically, if Lee claims at 62, her spousal benefit will be reduced. In fact, if you claim any benefit prior to full retirement age, any Social Security benefit, whether it's the regular benefit, the spousal benefit, or the survivor benefit, they will be reduced if you claim prior to your full retirement age. And each type of benefit has a different monthly reduction formula. Okay, what the percentage reduction will be different for each one. So let's say that for this example, that question, let's say Chris was 4 years older than Lee. So Chris claims at 66 and he gets his $2,000, right? Now, if Lee claims, basically she's going to get around 32%. There's a little, because she has her own benefit, it might be a little bit higher than that. But instead of getting 50%, it's going to be down around 32 or 33% of the full retirement age benefit, which would be what, about, I don't know, $660 or whatever. So yeah, that's how it works if you claim any benefit early. So it's actually, so the other side of this, well, no, that's it. The 1,500, if Lee waits till her full retirement age, she gets 1,000. If she claims any benefit early, spousal benefit included, it will be reduced. And one other thing about the spousal benefit with married couples, Chris has to claim his benefit first before Lee can claim a spousal benefit. She has to wait for that. There is a difference with divorced couples. If you were married for at least 10 years before your divorce and you never remarried, you're entitled to a spousal benefit. And if your own benefit is less than 50% of your ex-spouse's full retirement age benefit, you can get a spousal benefit, right? Now, we're married couples, you have to wait for the other spouse to claim. But if you were divorced for at least 10 years, or excuse me, if you're married for 10 years before the divorce, and you've been divorced for at least 2 years, then the other spouse, your ex-spouse, only has to be eligible to claim, which means they have to be at least age 62 or older. They don't actually have to be claiming their benefit, only eligible to claim. And the divorced spouse can then claim a spousal benefit, even though their ex-spouse hasn't claimed their own benefit first.
All right, I don't see any other questions, and we are getting close to the end here. So, Brian, if you're okay with it, I'll kind of wrap up here.
Absolutely.
All right. So, Brian, thank you very much again for all this valuable information, and to Ken Fish from Touchstone Investments for putting this together. I hope everyone found this information valuable, and if you have any additional questions or would like Brian to do an analysis for you, please feel free to reach out to us. Just as a reminder to everyone, we do promote and manage the HBRA 401k, and we would be happy to explain the benefits of the program over other options available. We have helped many members save money, simplify their lives, and reduce their fiduciary liability as a result of the HBRA 401k. Thank you all again for your time today, and have a great day.
Thanks, everybody. Thanks, Jessica.
Thank you.